The real estate market can be very unpredictable, but don't worry. Certified public accountant Shane Stroberg is back to guide us through the ups and downs and the do's and the don'ts, right? Welcome back, Shane.
Thank you for having me back.
So make us smart when it comes to real estate.
It's easy. Buy low and sell high. It's easy.
But we got to sell. You got to know when to sell.
No.
And the problem I find when selling, if you buy something else, it's high too.
Yeah, yeah.
And if I were to sell and save my money, I'd spend it.
I don't have the answers for how to make money in real estate, but I have the answers on how to report it on your tax return. That's what I can give you.
Okay.
I can't figure out how to buy the $200,000 house and sell it for $1 million, but that's everybody's goal.
Yeah.
The one thing you see out there for real estate sales is they buy a house and they sell it. And everybody has this thought of, if it's my residence, I don't need to report it, I don't need to pay tax, all these types of things, which is usually true. You don't have to pay tax if there's certain criteria on your sale.
Right.
But what you do need to do is report it. The quickest way to get a letter or get a notice from the IRS is to sell a $300,000 property and don't put anything on your tax return. Because the IRS gets a piece of paper that says you got $300,000.
Take it from the bank?
Yeah. So what are they going to do?
From the mortgage company or from the bank? Who
from
reports it?
From the escrow company.
They
when
all
escrow
rat
closes,
you out, man.
They
don't
tell you. They say, hey, they sold a property for $300,000. Well, you might have bought it for $400,000, and you have this giant loss, and there's no tax ramification. But if you don't tell the IRS, all the IRS knows is you got 300 grand.
Yeah.
And what do? They send you a letter and say, hey, you owe us 150. You know, that's how they go. So.
Give me your money.
Right, exactly. So we've got real estate sales. I call it the gains, the losses, and the ugly. So the good, the bad, and the ugly. Believe it or not, the losses aren't necessarily the ugly in the situation always. There's things worse than losing money in real estate.
Okay, but before we go there, because I don't want to forget my question, say that in that last scenario, they lost money, right? Now, can you write off that full amount, or can you only write off a percentage every year?
We're going to get there. There's different
am I jumping
things.
ahead?
You're jumping a little bit ahead,
Shocker.
So we have the gains, the losses, and the ugly. We'll start with the gains. Everybody buys real estate hoping to sell it for more than they bought it for. That's the plan. Doesn't always work that way, but when it does, you've got a couple different kinds of sales. You've got a sale of your residence, which has different rules. Then you have what's called a business use, or a rental property, investment property, something that you don't live in. Let's just put it in that basket of, I don't live there, so it's other. So you've got the principal residence. Everybody has this notion in their head, you don't pay tax on the gain from your principal residence. That's mainly true most of the time for regular folks selling regular houses. If you make money, Code Section 121 of the Internal Revenue Code states that if you're single, you can exclude up to a $250,000 gain. If you're married filing joint, you can go up to $500,000 on that principal residence if you satisfy a couple criteria. One,
you give them your firstborn.
No firstborn on this one. This one's pretty much a freebie.
What?
All you have to do is live there 2 of the last 5 years. So
that's
it's your family house, you live there for a couple years, and you can make $500,000 or less and you're married, you're going to get all that money tax-free. Okay? If you don't live there for 2 of the last 5 years, you can prorate that exclusion. In other words, if you live there for 1 year, you can take half of that exclusion, but you have to satisfy criteria. You have to be moving for a job. You have to have had an unforeseen circumstance in your life, which would be, I think the funny one in tax code is multiple births from one pregnancy. So if you have twins and you don't fit, you're allowed to move and still take part of your exclusion. Change in marital status, things of these sort, medical. You can get out early from that 2-year period and still exclude part of that gain. The other side of the coin, if you lose money on your residence, you get nothing. You don't get to recognize any losses on your tax return, not for your principal residence.
That's CRAP.
That's the IRS. They get you in both ways. So
how can you not report a loss if you've lost your down payment, you lost everything?
You don't get any credit for it. It's not a capital loss. It's a loss of life, I guess, call it. I'm not sure why the code is written that way.
Yeah, a lot of people.
It doesn't seem like it would make sense. But that is the case. So if you
and how sad people save all this money and they lose everything. They got to start from scratch. They spent years saving.
And wait, we're not even to the ugly part yet.
And we're not done yet. There's more.
We got gains, losses, and ugly. We're not even to the ugly part yet.
Okay.
So with the other bag we had over here, the other business, rental property, things like that, those would be business use property. If you have a gain on that type of property, Depending on your holding period, if you hold it greater than 1 year, it's a capital gain. This year, capital gains rates are changing around. I'm not going to quote any exact rates because they're different for different income levels. But capital gains rates are a preferable rate on that gain on sale of property. If you own it for less than a year, it's ordinary income. So whatever tax rate you're paying, that's what you're going to pay on that gain. Now losses, we said residential losses you don't get any love for. If it's a business loss, you get love for that loss. That's
so what
a
if you have
story.
A home office in your primary residence?
That's advanced. That's like upper division tax class there. But
I'm always advanced.
You can do that.
Okay.
I don't do a lot of that because one, you don't get a lot of bang for your buck when you're doing that, and two, it's very complicated to make sure you can explain the situation to the IRS because that's all they want you to do is explain why you're right. It seems easy, but sometimes it's not. So on those business losses, they get reported on Form 4797, and it's a form that reports gains and losses to figure out your gain or loss. You have what you paid for it. You have all the improvements, anything you've done to the property. If you buy an apartment building and you renovate it, anything you put into the property increases your basis in that property, and then you sell it. So the difference between the selling price and your basis is your gain or loss. That gets reported on your 4797, and you get preferential treatment for that gain if it turns out to be a gain, and you get direct deduction for that loss if it turns out to be a loss. So in essence, the business part of it, you do get love from the IRS. When it's your personal residence, you can't take a loss. Don't know why, it's their rules, not mine, I just follow them. Now the uglies. The uglies
oh my gosh, it gets worse.
The uglies are what you're seeing.
Where's the cocktails? I need a cocktail if you're going to tell me the ugly. Go ahead.
The last number of years, the real estate market has been very rough. You've heard foreclosure, you've heard REO property, you've heard short sale, you've heard all these different types of things going on for people underwater on their homes. To add insult to injury, if you are foreclosed on and you lose your residence, there's a chance you could also have to pay tax on top of it on the debt that you were canceled. So that's why I call it the uglies. And that's where...
Can you imagine you lose everything and you have to pay tax on that?
Not only can I imagine it, I've seen it a number of times right in front of me across the desk in my office. I mean, it definitely happens. And what also happens is people get bad information on how to report these things on their tax return, and they pay more tax than they should. It's a very complicated process to figure out when you have a 1099-C or a 1099-A, which is what you get for forgiveness of debt. A lot of times people report them incorrectly and pay a whole bunch more tax than they're supposed to. And they're not cheating.
Can they get it back once they do that?
There's definitely a way to get it back, to amend the returns.
Can we get it back from a government who's hurting for money?
They'll give it back to you, but if anybody's ever dealt with the government, they're never quick.
They're going to make you, they're going to make it painful so you give up.
They do. But there's a code section in the Revenue Code, Section 108, goes through forgiveness of debt and different ordering rules for how you can exclude debt. If it's your principal residence, you can exclude your principal residence debt if it's original purchase debt. There's a lot of people out there that bought a house, it went up in value, then they took out 50 grand and bought a car.
Right.
Those debts, when they're forgiven, they don't go into this bag, so you're supposed to pay tax on that amount of money that's not for...
Like the second on the house? Or
the seconds on the house. A lot of people bought investment properties with second. If it wasn't used to improve the residence, you're supposed to pay tax on that if it's forgiven. So there's a lot of rules that go into foreclosures and short sales and when you have cancellation of debt, and you can really make some grave mistakes on a tax return, pay a whole lot of extra tax, and then spend a better part of a year trying to get it back from the IRS once you realize there's a mistake. So
well, that's Section 108.
It's Code Section 108.
Or you could just call Shane and have him break it down for you, and you are the tax man. Hello.
Yeah.
I, for one, I don't even want to spend the time making sense of it. It just makes my head spin. So there's Shane's website right there, Stroberg and Associates, and obviously this man knows what he's talking about. There's a button there, Primetime with Taylor Baldwin, and we'll have all the segments. If you have any questions, call him, see him. I do.
Yes, you need to make that appointment. I'm getting busy.
I know.
I'm getting busy.
I know.
We need to have you in. And everybody in the studio, call in.
Yeah.
I'll take care of you.
You are awesome. Thank you so much for teaching us.
I hope it helps somebody.
Hopefully you'll put more money in our pockets and save us money when, save us from doing stupid mistakes.
I'll say this. Whenever somebody does have a bad issue and the tax return turns out bad, I always charge them less because I feel bad. So if nothing else, You know?
You do. You're a little bit,
Yeah.
you do. You're
If
a
it's
softie.
bad, I'll take care of them.
You're a
so.
softie, but you do take care of people, and
Yep.
you watch out for people, and that's really nice. You're an accountant, a taxman with a heart, and I love that.
Yeah, for 2 months a year. There's a whole rest of
And
the year.
get this, folks, he used to be a professional baseball player, and he's smart.
Yeah.
I mean, thank you, Shane.
Thanks for having me.